Gold is approaching a major liquidity zone where smart money is engineering a massive trap right before the New York kill zone. Today, my macro directional bias remains strictly bearish. Our main liquidity target is the buy-side pool resting at 4014, and my primary focus is a potential sell setup once we sweep that level. But there's a catch.
Most retail traders are staring at the wrong levels right now. They're trying to buy this temporary recovery, mistaking it for a macro trend change. Let me show you exactly where institutions are actually positioning their orders and why the market is sending a warning signal right now.
The question is, will you fall for the retail trap or will you follow the institutional draw on price? There is one highly specific condition that must happen first before we execute any position. If you ignore this, you become the liquidity. Before we break down the deeper market logic, let's cover today's executable trading plan and bias. This is the exact outcome you need to know for today's trading session. The current algorithmic status is a strict wait for confirmation. Price is sitting in a dangerous premium array right now. Executing blindly here introduces terrible risk to reward dynamics. Smart money confirmation hasn't appeared yet, so patience is your best tool right now. While we wait, map these levels immediately. My macro bias remains firmly bearish on the daily chart, but we're mapping an immediate buy-side liquidity target at the 4140 equal highs. On the flip side, our sell-side liquidity target rests all the way below 4100.
Let's move into mapping institutional liquidity on the higher time frames so we can understand exactly why smart money is targeting these specific areas.
Looking at the daily chart, we've got a clear macro bearish distribution. We've been consistently printing lower highs and lower lows. But look at where we are currently. Price is operating deep inside a discount array. The institutions engineered a sell-side liquidity grab, and now they're positioning for the next major move. But here's the problem. On the H4 chart, price displaced upwards, leaving a massive, unmitigated bearish fair value gap between 4140 and 4180. That open gap acts as a powerful institutional magnet. The algorithm is systematically drawing price higher to rebalance these premium inefficiencies before the macro bears take back structural control. And the market is sending a warning signal with today's upcoming macro catalysts. Institutions will likely weaponize the 7:30 p.m. Canadian employment data and the Fed monetary policy reports. They use these high-impact data drops to engineer the exact volatility needed to rapidly sweep those premium arrays.
Let's dive into the executable ICT trade scenarios. We know the bias and the targets, so let's detail the exact parameters for our two high-probability paths.
Impartially, we're prepared for two distinct outcomes today. The dominant higher time frame play is a short setup, targeting that massive sell-side liquidity below 4100 once premium levels are mitigated. But because the intraday order flow is bullish, we also have a long setup drawing price directly into those 4140 equal highs. We trade whichever one confirms first.
Here is the executable plan. For the sell setup, we want entries between 4140 and 4160, targeting 4080 down to 4100. For the buy setup, we're looking at entries between 4011 and 4118, targeting up to 4145. And crucially, your risk must be strictly capped at 0.5% to 1%. Scale out at take profit 1 and move that stop to break even immediately. Now, on the 15-minute time frame, we absolutely must see a confirmation trigger. We need a minor liquidity sweep followed immediately by a violent market structure shift to the upside. If price just bleeds higher into 4140 without giving us this strong entry footprint, the setup is dead. Don't chase the move. So let's talk about the trap and exactly what retail traders will miss today.
The algorithm is setting up a liquidity sweep. This is an engineered, rapid price movement designed specifically to trigger retail stop losses. It creates a false breakout, tricking retail into committing capital in the wrong direction right before the true macro direction unfolds.
Look at the H1 chart. Retail money is blindly buying this current bullishness, completely ignoring the massive pool of sell-side liquidity resting below 4100. Those equal highs at 4140 are highly magnetic, for sure, but they're most likely being engineered purely as a buy-side trap. And this invalidation level changes everything. A complete closing criteria below 4100 invalidates the entire intraday bullish narrative. If we see a solid close below that level, the buy scenario is instantly dead and our focus shifts entirely to shorting into discount levels.
Let's lock in the final invalidation and risk protocol before the session volatility really begins.
Remember the core framework.
Our bias remains tethered to the higher time frame bearish structure. We strictly wait for M15 structural confirmation. Our primary targets are the buy-side liquidity at 4140, followed by the sell-side liquidity below 4100. And as always, never risk more than 1%.
If you enjoy institutional-style market analysis using ICT and smart money concepts, subscribe to ICT Market Theory. And if you'd like to trade alongside these setups, you can find the FXTM account link in the pinned comment below.
The trap is set and the levels are clearly marked. The only question left is, will you be the liquidity today, or will you wait for confirmation, follow smart money, and profit from it? Keep a close eye on that 4140 level and trade safe.